tell you how to get a property with 3.5% down opposed to 25% down, that's 1/8 of that down payment. So, yeah.
So I didn't know that a multifamily, especially a 4-family, would qualify for an FHA loan. This is the first time I've heard that. So
Most people don't know that.
I
So
didn't know that. Thank you.
our main job is debunking the myths. If you have an FHA loan now and you sell that home that you live in, you are still eligible to qualify for a new FHA loan. So let's say you have a 1-family, you and your wife are like, you know what, we don't want to live here anymore, we want to buy a 4-family, and you sell that current home, you could now get a new FHA loan. It's not only for first-time home buyers, but most people don't know that, and banks aren't going to tell you that because they don't want to take on the risk. They want you to put 20% or 25% down to reduce the risk, right? They're eliminating or they're minimizing their exposure by having you put that much money down. And again, they're not here to tell you what's best for you, they're here to tell you what's best for them, right? So what's interesting is one of the hottest, assets in the market everywhere are condos. Well, most people don't know that we can go up to a $700,000 price on a condo and put a 5% down payment. And I'm doing this purposely so you can see that you're still out of pocket $35,000, right? So this comes down to the person that has $40,000 saved up. Do you buy a $700,000 condo, put 5% down, have a $665,000 loan, or do you buy a 4-family for $1 million, live rent-free, and still lay out of pocket $35,000, right? So this is comparing, one scenario to another, but this is a real-life scenario consumers, millennials, are faced with. Do I buy the luxury, beautiful $700,000 condo and lay $35,000 out of pocket? Now, if you go into a big bank's like, oh, you're buying your first property? That's nice. We need you to put $140,000 down. Because they want, you're a first-time home buyer, you're buying a big property, it's a high-balance loan. No, you need 140. Well, no, you don't. We have a conventional loan product that you only have to put 5% down. Yeah, you're going to have a higher payment, obviously, right? A little bit different in payment, but why would you lay out $140,000 when you could lay out $35,000?
This is specifically for condos?
This is specifically for condos, yeah, yep. So condo is obviously in a building. Now there's different factors that come into it. There's something that's called warrantable and non-warrantable, but this is a straight, hey, new development, beautiful project in Astoria, I want to live in my whatever, whatever it comes out to, 800 square foot condo, I want to buy it, I don't want to be a landlord, but I'm making good money. Well, okay, if you're making good money and you can afford this, lay out $35,000, keep $100,000 in the bank. Even if you have the affordability of doing that. And if you don't, just so you know, you can actually get a gift. Let's say you wanted to put 20% down. You tell your parents, okay, you know what? I'm going to lay out $35,000. You guys give me a gift of $105,000 if they want to, if you have the opportunity of doing that, your wife, your mother, father, whoever. And they give you a gift and you can still qualify with that 20% down payment. So there's different ways of getting there. But on this type of loan, you have to have at least 5% of your own funds in the transaction, okay? So, yeah.
So, this warrantable versus non-warrantable. Can you explain what the difference is? Because the first time I ever heard of it was that 75 Palisades transaction.
Yep.
And I didn't know what that was.
So this is an old antiquated rule. This is a Fannie Mae rule, and it comes down to, okay, you have a condo, and is the condo warrantable? Or non-warrantable, right? Now, the main factor that comes into this is what are called owner-occupied versus rental units, right? So let's say, for example, there are 8 units in a condo building. So now, you don't know this, you're a first-time home buyer, you go on Zillow, you want to buy this condo for $300,000, everything's great, you have an approval for 5% down, right? Because we just said we can go up to $700,000. But that's only for non-warrantable condos. So you have to get something that's called a condo questionnaire, and management companies of building charge money to get this, right? It's a whole skewed process because it should always be available, but that's a way for the management companies to make extra money for themselves. Complete, total bullshit, right? You're filling out a 2-page form and charging $150, but you as a consumer don't know, or the realtor won't know if the condo's warrantable until you pay this fee. So why would I pay $150 to find out if this is available? You should know this up front. And most realtors don't know, right? They just take the listing. They don't really care, they just are focused on their sale. So if you're buying a condo, you say, okay, 8 units. First thing you ask yourself is, how many units are owner occupied? Now, I'm not gonna give you the full percentages because it changes based on how many units are on the building, 4, 8, 12, 50, 1,000, whatever. So if one thing to look for is if there are more rental units than there are owner occupied units, automatically the condo is non-warrantable. So that eliminates your 5% down payment option.
So if there's more, say that again, I'm sorry.
So let's say you have 8 units, right?
If it's primarily owner occupied.
Yeah, so let's say, as an example, unit 4 and unit 8 are owner occupied. Units 1, 2, 3, 5, 6, 7 are rentals or vacant,
Right.
or second homes. Your ratio would be 25% owner occupied, 75% rental, vacant, or second home.
Right.
So Fannie Mae says, oh, high risk,
Because most people don't own it, so they don't have interest.
they don't care. So the number one default in the history of the market for mortgages are investment condos. Investment condos. Now most people buy a condo as a primary residence, they move out and buy another home and rent that unit out. So they bought it as a primary, owner occupied, but then they said, you know what, let's just rent it out because the rents keep coming up, it makes more sense to keep this than sell it. Well, in this case, if you wanted to buy an investment condo, okay, the market, whoever makes the market, the market, says you have to put 35% down if you want to buy an investment condo, opposed to 5% down, right, as an owner occupied. Now, we have options where you could buy a condo at 20% down. A friend of ours just bought 2 investment condos with 20% down, but his rate was 5.5% opposed to the 4.75% he could have got. Well, why? Oh, well, my bank said 4.75%. My bank said 4.75%. Yeah, but you're laying out 15% extra as a down payment opposed to 20%, right? So at the end of the day, yeah, you're getting a higher rate with us because we're allowing you to put 15% less down. So on a $200,000 deal and you're buying 2 of them, we just saved you $60,000 out of pocket. See what I'm saying? 200,000 times 15% is 30,000 times 2 is 60,000. So with us, you were able to buy 2 condos, 2 investments, rather than only buying 1 and having to put 35% down. So again, every single borrower is based on what that person is looking for. If you tell me you want to buy 2 properties and you're working with 100,000, well, you probably want to go with the 20% down option so you can buy your 2 properties, right? Get a higher rate for now with no prepayment penalty. Once the market goes up, we just refinance you and get you down to the 4.75 or 4.5% rate. People look at their rate as the biggest factor. It's not. It's all about your strategy and your goal. But again, back to the non-warrantable condos, this is something that if there's litigation on the building, let's say for example, I own my unit, you come over, you slip and fall because there's water in the main hallway, now you sue the building, well, if there's litigation going on, it makes it non-warrantable. If the condo bank account, management company has a certain amount of money in it, it might also make it non-warrantable because there aren't enough funds.
Can I talk for a second? Are you guys gonna be here for lunch?
Yeah.
Yeah, Dennis is gonna keep him.
Oh, nice.
So,
Awesome. Tell them to get whatever you want. So if, let's say for example, the bills of the condo are $1,000 a month, insurances, upkeep, water, whatever they are, right? And the condo account only has $2,000 in it, you only have really 2 months of reserves. So that might deem the condo non-warrantable because the financials of the condo aren't as strong as they could be. Now, there are ways of getting around this for first-time home buyers, people that want to buy a primary residence. But when it comes down to an investment, you need to know all these factors to deem, is this worth it, is it not worth it? Because unfortunately, again, banks' jobs are to eliminate all risk and put all of the burden on a borrower, right? So even if this happens, you still owe us your money, and we're gonna back you into the corner, right? We're lending you money, so we're gonna protect ourselves and our investment. Well, on situations like this, not only are you as the borrower screened, approved, the condo building and financials itself are screened and approved as well. So you might be fully approved, the condo's not, you get denied for the loan because the building isn't approved. So again, as a first-time home buyer, do you want that other added risk? It's anxious enough buying your first property. Now not only are you worried about your own loan getting approved, you're worried about the building getting approved as well. So there's two different levels there, right? So that's the biggest factor in looking at a condo and finding out, first question is it warrantable or non-warrantable? Number one thing I can recommend, because we have people go through the process only to find out later on the condo's non-warrantable. Now you've already paid for your inspection, you paid your attorney, you paid for your appraisal, and now the condo gets denied. And now you have to maybe come up with more money. Or now maybe you have to shift your pre-approval from this property to a different property and you start the whole process over again. So the more that you know about this, the more you're going to be able to make an educated decision. How do I do this, and is this the right move? Cool. You have any questions on those at all?
Not